Hello everyone, James O'Reilly to provide you with Northeast Winter 23 economic updates. As always, general advice disclaimer, you know the drill, so let's get started. There are four key things that we want to address in this economic update, and all of which with a fairly healthy dose of optimism. So let's get started firstly with inflation data. The June quarter inflation data came out only a few days ago now, and critically, we are continuing to see a reduction in inflation, which is music to mine and everyone else's ears. You'll see from this graph, of course, this is not just related to inflation in Australia. Domestically and indeed across almost all OECD nations, we're seeing inflation that really came about post-COVID. We're seeing that reduce, which is incredibly encouraging. It's particularly encouraging because, of course, domestically, the way that we're feeling this, perhaps the most heavy way, or many people are, is, of course, in interest rates. And with inflation now reducing, we're starting to see a really compelling argument to leave interest rates as is. I'm going to take you through the three big reasons why I think interest rates are either going to remain as they are, or if they are to increase very marginally. We are very, very close to the top here. The first one is that the June quarter inflation that was just released a few days ago, firstly, it was lower, but importantly, it was lower than RBA expectations, and that's incredibly encouraging. In the past, the interest rate rises have been based on saying inflation has been above our expectations. We're still looking to get on top of it. Now, I note that it was very marginally lower than expectation, but it's still lower. We'll take it. The second reason is that the fixed rate cliff is upon us. And for many of you will have heard this expression. There's a tremendous amount of fixed rate mortgages that matured in 2022 and then obviously 2023 and 2024. And for those of you who have had the experience of having a fixed rate that perhaps was locked in at 2% and revert to 5 or sometimes 6%, it is pull your teeth out painful. And we are at the peak. In fact, we've just crested the peak of the fixed rate cliff. And I can tell you this has to be on the RBA's mind, because when they're considering the effects and the things that are going to drive consumer behavior and result in a reduction in spending, one of the key things is more households reverting from what was a cheap fixed rate to now a very expensive variable rate. And we are now just cresting that peak, but we have a huge belly of fixed rates to end in the coming 5 months. And I'm certain if you're the RBA, you're thinking very carefully about the behavior of the tremendous number of households, the financial behavior, of course, of the tremendous number of households who do have their costs spike significantly, whether the RBA make any change or not in future monthly meetings. So a very compelling reason to say, look, let's not pump the gas again. And the last one here is RBA's current track record. Now, some of you might point out that, well, the RBA's track record has been to keep hiking up rates for the last 12 months. Yeah, and to a point, that's correct. But I think it would be remiss of us not to point out that, especially of the more recent opportunities they have had to hike rates, they have taken their foot off the gas here. Now, this is 12 months since they started increasing rates, and you can see these 0.25 and these 0.5% increases, weren't they awful? And then we've started to see a more gradual increase. There was no increase in January, but that's very simply because the RBA doesn't hold a meeting in January. Apparently they deserve holidays. But there was no increase in April, and again, no increase at the beginning of July. And that is to say that over the last 4 RBA meetings, 2 of them have not had any interest rate increase. There is a very clear reason for this, and it is that the effect of interest rates on an economy is very profound, and it's very hard to reverse if you take it too far. So if they are continuing to increase interest rates and that starts to have a negative effect on the economy in terms of inflation falling very rapidly, unemployment spiking, and the myriad of problems it can create on the opposite side, well, it's very, very hard to reverse that and start to kick an economy back into action. We've already got an economy that's moving very, very efficiently, too efficiently in some respects. And so as a result, they're trying to curb that rather than jam it. So putting all that together, I'm quite optimistic that we are, as I said, we're either at the top as we speak, or alternatively, if we're not at the top, the RBA would be looking to land that final knockout blow in order to say, let's just make sure that the behaviours change, that consumer behaviours change. Now, of course, we're going to learn more about consumer behaviours in the coming months as we see more inflationary data come through. But based on the visibility that we have right now, I would really like to press on so many of you that might be feeling the pinch of inflation and higher interest rates. To quote the Little River Band, hang on, help is on its way. I think that we've crested this, or we're very, very close to it. Let's kick on to one other consideration here, which is around serviceability changes. This happened very recently, which is that in the past, if you are looking to take out a loan or refinance a loan, then APRA, the Australian Prudential Regulatory Authority, who govern all the banks, they said, we want you to have a 3% buffer on all of your loans to make sure that if someone can actually pay for a loan, they should be able to pay for that plus a scenario where the interest rate is 3% higher than that. And recently, 3 of the big 4 have changed that or stretched that to the buffer now being 1% for refinances, provided the loan to value ratio, the LVR on the property, is below 80%, which is, for many Australians, if you've been lucky enough to have your home for a few years and seen that the value of that grow. So the implication here is that those banks are trying to avoid what's called mortgage prison, where you've got this high mortgage, but you can't refinance it anywhere different because you're jammed because of the sudden spike in the cost of that loan. And you can see here for individual incomes in this hypothetical scenario that we put together that your ability to refinance a loan is well beyond your max loan capacity. And this is really important for a couple of different reasons. The first one is that if we do start to see rates fall somewhat, this is only going to open this up and allow more Australians to refinance. That's a great thing when interest rates are high. People deserve to be able to get the best rate that's available to them because obviously it's making a huge difference. But the other consideration too is that idea of if you have an asset right now which is under 80% and you're considering selling it and then potentially buying another property, even if you're looking to go down, like as a downsize, please consider the possibility that even with that downsize, you might not be able to afford the new mortgage, despite the fact that your old mortgage was higher. And that's a very important consideration, and probably we'll speak more to that as we move across to the property section. Let's move across to equities. We're going to go to Australian shares, and what you're looking at is the ASX 200 over a 2-year period. Incredibly choppy, incredibly tumultuous 2-year period. And one of the rare times that over a 2-year period in the ASX is actually down, despite everything that we've experienced so far. If we move across to US shares, we see a very similar story. We're looking at 2 lines here, the red line, of course, being Dow Jones and the yellow line being the NASDAQ. Again, what are the consistencies? We're seeing a pretty high level of volatility, particularly true of the NASDAQ. And we're also observing that over 12 or 24-month periods, both of these positions are actually down, which again is rare, but it's also for some very deliberate reasons. And one of the obvious ones is inflation. It's the concerns of how not only the high inflation we have right now, but then also the concerns of how are we going to manage that period as we try to curb inflation and the impact of potential recessions and so on. For that reason, when it comes to equities, I personally have a pretty high level of optimism in this market because I think that if we fast forward 3 or 4 years, for example, we're going to have all of those answers. And it appears to me that quite a bit of the concerns around prospective inflations have actually been priced into markets already. And so for that reason, it's not to say we can't see more volatility, but if we see some good news stories, the market could respond really strongly to that if we're able to walk that line of getting out of this and curbing inflation without necessarily going into these significant recessions or not going into recessions which are significant. Now, a message to many investors that we're communicating here is that concept of investing for the long term. If you've been investing for the last 24 months, you very well may be in a position where you've made very little money. We just talked about the major indexes, Australia and the US, and how over a 24-month period, they're actually down on just more broadly. And it's a mistake to take the lens that is the long-term trajectory of these markets. Unfortunately, this is just the reality that we've experienced for a very short window. And so I've zoomed out here. This is the Australian share market over the last 30 years, 1993 to 2023. we're really trying to implore to people to take a long-term view. These last 2 years have been difficult, and there really has not been the value for investing that you would traditionally get. But rest assured, that is not the long-term trajectory of equities. That is the long-term trajectory of equities. And over the long term, if you are to remain invested, you are going to experience these trajectories. So please stick with the game. I'm reminded of that magnificent quote by Warren Buffett here, which is that the stock market, as it says, is a device to transfer money from the impatient to the patient. So where possible, please be patient, because the longer term outcomes associated in your investments, in your super, they are significant, they are pronounced. And if you look at this with short-termism, at what happened over the last week, month, even year, I'm sorry to say it, you might feel like you're not getting the outcomes that you deserve. Again, zoom out, rest assured that they do happen. Let's lastly move across to the property markets. And again, some good news, which is that if we look at house prices across the capital cities up to the June quarter, we actually saw some pretty pronounced increases across a number of different markets. Sydney led the way at plus 5.3%, which is obviously a pretty significant increase off the back of, I know, a pretty poor period. The year-on-year result is flat, which means that it lost 5% over the first 9 months of that year. Melbourne has a bit of recovering to do, of course, as you can see. The clear winners in this market at the moment are, for example, Perth and Adelaide have done quite well here. Regardless, it's really encouraging to see some pluses here. And again, one of the reasons for this may well be that consumers are feeling a lot more confident, homeowners are feeling more confident, and just property purchasers in general are feeling more confident about their ability to be able to fund these debts and their ability to see out this period of really high interest rates. So our view is that if we are able to come off the rates come off the boil, we get over this crest and we start to see a reduction, we see no reason why property would continue to perform poorly. We think that that period, if anything, is probably likely to create a little bit more excitement in the markets and people feeling more confident. If we see more investors into the market, we see more first-time owners, and the extension of that is that we're going to see higher property prices. That's everything for me today. Thank you so much for jumping in. If you have any questions about any of this, please speak with your financial advisor. And obviously for our members, we would love to support you wherever we can. Thank you, everyone. Chat soon.